The difference really is, how is that building owned? Does the unit owner own the building, or does the association own it? The association owns the building, it's a condominium project.
So they both have HOA.
They do, yes.
So that doesn't tell you one way or the other.
Correct.
That's
Yeah.
why realtors will ask them, is it a condo? And they'll say, once it has an HOA, they both have HOAs.
Yeah, because that's the answer I got when I asked some people. They said, well, if it's an HOA, then it's fine.
No,
Sometimes you can tell based off of how expensive the HOA dues are. So
Yeah.
like, if I get someone that's like, oh, it's just an HOA, but the monthly HOA payment is like $250. I'm gonna be like, that might be a condo, can you please check? Because normally they have to have higher HOA dues because they're paying for external maintenance of the property. And so they need to make sure that they have someone to mow the grass, that the roof gets replaced if it needs replaced. If shingles or if siding is missing, if anything needs painted, that's what those HOA dues are going into. So they're 9 times out of 10 going to be more expensive than just the standard flood.
and that's where you have these overlaps between the two, and that's where the confusion often lies.
Yes.
Having an HOA, they both do. Having common areas, they're for use of anyone that lives there, that they both have that, both pay dues to the HOA. And if someone's selling a unit in either type of project, they have to get a resale certificate from the HOA, which sometimes.
I'm sure we have long experience.
Yeah,
But yeah, the first difference is ownership of the building, which then crosses over into who maintains the exterior of the building. Now, there are some HUDs that are attached units, and so in that case, sometimes attached units, the HOA will take care of like the roof, if the roof needs replaced, because it's one roof covering multiple units. But for the most part, external maintenance is by the owner. Condo association. And then the other main difference, which is the bulk of what we're going to talk about today, is approval from the lender. If it's just a HUD, they do not need to be approved ahead of time. All we need to do is resell cert and make sure that the insurance is good. But for a condo, they need to be approved for government financing, and then conventional loans will need additional documents as well, which will change. Any other questions about the differences?
okay, other differences, the appraisal forms. If it's in a planned community or a planned unit development, then it's treated just like any other house. It's the same form that's used for a single family detached. If it's a condo, there's a special appraisal form for condominium. Because it breaks down how the units in the condominium project, how many are up by owner occupants, how many are second homes, how many are resident properties, and other information. Homeowners insurance. If that community or HUD gets normal homeowners policy, it's no different than if you bought a single family detached home. But a condo policy requires a special one called HO6. Standard policy is called HO3. The HO6 is what it says there, painted coverage. The coverage just the improvements, the betterments of the building. It doesn't cover the building itself. That's what the HOA is covering with their master policy. Rate pricing. A planned unit development or planned community is treated just the same as any other property. It's standard single family detached property. There is no pricing difference in rate. That's not true with condominium. If you're putting less than 25% down on a condominium unit, you're getting a 0.75% hit to the price of the rate, meaning you're paying 0.75 of a point to get the same rate as somebody that's getting a planned community property. So there are rate adjustments involved with condominiums. Those are considered riskier. The HOA dues, as Angie said, condos typically have higher HOA dues because they are insuring the entirety of all the buildings in that community, plus covering any maintenance, anything involved in the common areas, all of that stuff. So your dues are generally higher as a result.
So how can you tell the difference? You have to ask. You can't just look on what that property looks like. You definitely have to ask. Your title company can pull the recorded declarations of an association, and that will tell you whether it's just a PUD or if it's condo. Pro tip: if it's your listing, please find out the legal name of the HOA or the condo association and add that to your MLS listing. Because as you'll know in future slides, I will need that for government funding because I'll need to make sure that that condo is approved. So if you have it in MLS, then no one's gonna keep bothering you about what the legal name of the condo association is, because you already have it written.
The importance of that is when communities are formed, they are formed legally under two different regulations, legal regulations. And that's what that recorded declaration is. It'll stay on the first page. This is formed under the Planned Community Act of law. It's condo will say formed under the Condominium Act. So it will state on the very first page of that document what that community is, and that's how you can tell. I have run into one situation where a community started out as a condominium, later changed it to a planned community. You're able to get the legal documentation proven that allowed us to pursue the loan in that manner. But that's pretty rare, obviously.
And sometimes depending on the building and the phases, not every condo in a big project is under the same association name. So it's always important to look it up because it might be in a different phase, which means it's a different name. And that could be important for looking at everything.
That's quite true. Winding Hills and Mechanicsburg, you've got single families, you've got sections that are different condo associations within that neighborhood. So depending on where it's located in the neighborhood, it's one condo association. Somewhere else in the neighborhood, it's a different one. So you have to be careful.
I've also had, there's a few places in the area that have both a condo association and an HOA, and they pay dues to
Both.
To both.
Yeah.
So always look at. How does this affect lending? For a PUD, it doesn't matter. There's no additional documents that we need for a PUD. We don't need them to be pre-approved. We don't need anything. For condos, it does, and it depends on what type of financing they do, will depend on how much information that we need.
Okay, so with condos and conventional loans, you've ever heard of the terms warrantable and non-warrantable condominiums? What that means is that Fannie Mae and Freddie Mac have a certain set of standards that the HOA has to meet in order to be considered eligible property for financing. That's what the warrantability means. What are some of the key bullet points for warrantability? Generally, the units have to be 50% or more owner occupied in the community. If it's 75% investor, they're not going to want it. It becomes non-warrantable. That there are no lawsuits pending against the HOA. That no single entity or person owns a large percentage of the units. Generally, it's 10, sometimes 15% is the maximum that one entity can own within the condo project. The HOA has to have healthy reserves. 10% is the minimum budget for that. So the HOA has to have not only what they need to operate and pay their bills, but they have to have reserve funds just in case something comes up. Those are requirements. These are just four. The questionnaires are 4 pages long. There's a ton of questions that are asked. These are just common things that generally will make something non-warrantable, but there are other things that they look at too.
And at this point, we're just talking about for conventional loans.
This is
Yes.
just conventional. Yeah. Yeah, that's what we have to send a questionnaire out to the HOA. If they use like HomeWise docs or condo service, they charge you a ridiculous amount of money to fill it out. It's like $400. It's crazy. So there we go. Want to go? Okay. Okay.
We have a question.
Sorry.
Just guys.
Yeah, that's fine. I wanted to make a comment a couple of slides ago, because this just, you were talking about some developments had the HOA and they have 2 HOAs.
Yes.
So we ran across a situation 30 or 45 days ago that we didn't know, and I'm learning something still all the time, that when you've got that, you need 2 resale certs, one for each.
Yeah, you do.
And the one resale company won't tell you that you need to. Nobody tells you.
They're always about.
It's, we find out after the fact.
Yeah.
But if you have that, you need a resale cert in both
For each
each
association.
association.
Yes,
So
they're
the
separate.
homeowner is getting dinged for 2 resale packages.
Yes, they are.
Yes, yeah.
They sure are. It's quite true. Lenders condo. So what are they looking for? What do they need to determine if for a conventional loan, this condominium sale can go through and be a warrantable condominium? if the borrower's putting less than 10% down, it's considered a full condo review. There's a lengthy questionnaire. Again, it's like 4 pages long with a bunch of questions for them to fill out. They have to provide their budget for both operating and their reserve accounts. Again, to prove that they have the reserves that are required by Fannie Mae and Freddie Mac. And they have to look at the condo master policy. This is something that over the last couple of years has become very troublesome. Because they look at not only, well, does it have guaranteed replacement cost of the buildings? They're looking at every single peril deductible to make sure that the peril deductible is not too much over a percentage of the value of that unit for each thing. So sometimes an HOA will have a policy that has guaranteed replacement costs, but if you have ice damming that causes water damage in the unit, they'll say, well, per unit, there's a deductible of $25,000. That exceeds 5% of the value of that particular unit. That's considered insufficient insurance. They won't fund the loan. So it's become very tedious. If they're putting 10% or more down, there's a shorter form condominium called limited review. I think that one's only 2 pages long. They don't need to see the budget. They do still need to see and review the master policy, same guidelines apply. In that respect.
One thing I remember coming up recently, in the last maybe year or two, is a condo we were trying to get, the roof needed replaced. And that became an issue because they made a comment on the condo questionnaire. Do you want to say something about that?
Yeah, so what they are, ever since, remember the condo that collapsed in Florida? Yeah. Ever since that happened, now there's 2 pages of questions about when's the last time this building's been inspected? What were the results of that? Are there repairs that need to be made? Are you aware of any repairs that need to be made? Is there an additional HOA requirement for additional dues from the unit owners for a number of years to cover something that they know is going to need to be replaced in the near future? They call it a special assessment. It's in addition to the normal HOA dues. They ask all those questions now. And if they say, yes, in fact, there is a problem, which is what happened on my deal, the roof needs replaced, but the weather's been so bad, because this was back in December, that they haven't started work yet. We were told, well, the work has to be done before you can close. And it's not just the unit you're buying, all the buildings have to have the roofs replaced and proven. Now, see, I was doing this investigation work up front and got answers just in general from the condo team that reviews the condos. When I submitted the file to the lender, the underwriter didn't say anything about it, so we closed anyway.
But it could have been an issue.
It would have been an issue, but I wasn't going to tell them.
Yeah. So keep that in mind. So for government loans, there are 2 websites here. One is a HUD approval, and one is a VA approval. For any government loan, either FHA or VA has to approve the condo association. An FHA approved condo applies to both FHA and USDA loans, and the VA approval applies to just VA, but USDA will do either one. They don't have their specific ones, so if they approve one or the other, USDA will be fine. The issue becomes VA is a single approval at the beginning. It's done. You don't have to get reapproved. You don't have to get recertified. You're approved, period. FHA requires all associations to be recertified every 2 years. And a lot of HOA or condo associations don't want to do that because it's a lot of paperwork. So you'll see a lot of FHA condos expire.
It's paperwork and it's money.
Yeah.
It's like $2 grand, $3 grand now for them to be certified with HUD.
So, and this is where I would need for you, because you can look it up, the legal name of the association. Yes.
I know for some associations, you can do like a spot approval.
Yes.
And press. What are like the requirements or how to go about that? So like,
Funny you should ask.
It's coming. I promise. So we are not going to do a questionnaire because everything is pre-done by a VA. So everything should be done upfront, so they don't have to worry about it during underwriting. But we do still need a master condo policy. They do still need to review that to make sure that their current policy is up to date.
FHA single unit approval.
It's possible.
Yep.
If a condo is not in a HUD approved condo list, we can try to do a single unit approval. I just actually was talking to my lender rep about this maybe a week or two ago. You can't start the process until you're under contract with it, and then the lender has to do it themselves, and it takes 5 to 6 business days for HUD to get back to you on single unit approval. There's a very long list of documents that we need to gather for it. So I don't know how long that process is gonna take, but then once everything's submitted, it's 5 to 6 days.
Yeah, now, the importance of all of that is to do an FHA appraisal, you have to have an FHA case number assigned. They will not assign a case number to it until they approve the single
Right.
unit approval.
So if we're trying to do this, please give at least 5 to 10 extra days. I would say 10 to be safe. Because Lord knows how long it's gonna take to get the documents from the HOA in order to submit it.
Yeah, and you have the government doing things on their time.
Right. But some of the things that they need, the condo situation needs to be at least 5 units. It has to be 50% or more owner occupied. Maximum 35% commercial space, no more than 15% of the units can be within 6 days delinquent. And the most important thing is that maximum FHA saturation is 10%. So they won't approve it if more than 10% of condos are already using FHA financing. So if it's a 10 unit and one of them is FHA, you're probably not gonna get a spot.
Yeah.
Yes.
When we go to show the property, we have no idea. That was coming into play.
Right.
Yeah, now the websites might be. Anyone can access, you don't need to log in. So you can go in ahead of time and click that.
I'm pretty sure the FHA one actually does show what the saturation is.
They might, but that was the last time it was certified. I don't think that's.
Yeah. That's true. That's
I
true.
mean, obviously, we know it's not FHA approved, we're already taking that chance, but. For us as realtors to figure out all of that ahead of time, try to determine.
It's gonna be,
Big channel.
Yeah.
you almost won't know until we try.
Okay.
So there might be a fall off rate. I mean, thankfully, we can't order an appraisal until everything is done, so no, it's gonna be losing money that way. I would almost even, I don't know how the inspections work, but I almost wouldn't even try to get an inspection until it's.
I want to ask our lender rep and see if there's a way for us to find out what the FHA saturation is before we start. Because I mean, I would have the records, so we're just gotta be able to find out.
As a listing agent, you might be able to reach out to the HOA representative, they might be able to find out. I don't know.
I mean,
So this is an option, but it's not always good.
yeah, it's a gamble.
So to review, just for condos.
Yeah.
For conventional financing, we just need a condo questionnaire. We do that during underwriting. For government financing, it has to be approved ahead of time, or we can do a single unit for FHA. VA does not have anything like that, so if it's not VA approved, it's just done.
I guess, backtrack a little bit. Warrantability, non-warrantability for conventional, if it ends up being non-warrantable, it means you can't get a conventional one before. So that means we gotta find somebody who will hold the one and hold it as a portfolio product, so it can't be sold, can't be back to the lot, except. Certain few and far between too.
All right. Any other questions? Yes.
Because this, and I don't know where they for. That's correct, but we had issues with the association, I don't know if it was saturation or something about how they did their books, like they're dividing X amount, the FHA was requiring X amount to be like state up or something like that.
Reserves, yeah.
Okay, and the association was unwilling, so like they had to go there and their books were unwilling, so we were really close to the approval, but that like blew it up. Is
Yeah.
that a comment, or be like, what's that kind of workaround, or how can I, which was gonna be like,
That's part of the review when they're
oh,
reviewing.
so that's another review, okay, yeah, so they were unwilling to do whatever was necessary for like reserves needed.
And that could be,
Okay,
we won't run into, we're trying to get into.
got it, okay,
Yeah, and it could be anything, like just the things that I listed are just the more common and it'll be easier to find out ahead of time, but if they are unwilling to update their insurance to be insured based off of HUD standards, that could be a wall. If they don't have enough reserves, that could be a wall. If there too many units are delinquent, that could be a wall. So some of those things we can know ahead of time, some of them we can't. And so has to reach out to them again, I'm talking.
Yeah, that Florida condo collapsing sent a ripple effect.
Yeah,
Lending industry, so now the insurance is really low to par.
okay.
Yeah,
Another thing to keep in mind when you're talking to lenders about like qualifications and pre-approvals is if you know ahead of time that that person's looking at a condo or an HOA or a club, let us know. Because we don't always include that, especially if debt ratios are really tight. I'm not just assuming that they're going in with wanting to be safe. So like if I get someone pre-approved for 225, but their debt ratio is really tight, but they want a condo and their condo association dues are 250, that could push them to not be able to purchase that. So just keep that in mind when you're showing those types of things to make sure that they can actually afford the monthly payment.
yeah, it won't be a KWCPA with set type part of the government. This is an absolute max, can't go over this price, these taxes, no way changes. So we don't follow that trap.
But not everyone is diligent, so just keep that in mind with your buyers.
Yeah. Okay. Yeah,
And that's slide in at the website address, you guys share that in email or?
yeah,
Yeah, I can get it over to Taylor for you, Would
Absolutely.
Thank you.
Mm-hmm.
for sure. All right. Let's wrap on our training for today. If you have any questions, just reach out to us. We're happy to give support to you, not just with condo questions today. Help.
Thank you, appreciate the time.
Yeah. Thank you very much.
It's easy.
Yeah.